Come on in, sit back and relax. You're listening to episode 257 of the WealthTech Today podcast. I'm your host, Craig Iskowitz, founder of Ezra Group Consulting. And this podcast features interviews, news, and analysis on the trends and best practices all around wealth management technology. My guest for this episode was Iraklis Kourtidis, founder and CEO of Rowboat Advisors. Now, Iraklis has a long career in the industry. Before founding Rowboat almost 9 years ago, he was a software developer at Wealthfront, working on investment products. Before that, he spent a few years building automated trading strategies. And before that, he was VP, head of U.S. single share trading strategies at Goldman Sachs. We spoke about some of Rowboat's products, including their portfolio optimizer and their tax simulator, as well as their approach to software development, which as as a computer science major at some point, used to know how to software develop. So I thought I was like talking about software development with the experts. So we talked a little bit about their approach at Rowboat Advisors. And of course, no product discussion would be complete without a little bit of the roadmap, what we're expecting from Rowboat in the next couple of months. Now, speaking about portfolio optimizers and tax simulators, here at Ezra Group, we're experts on all advisory software, including CRM, portfolio management, portfolio rebalancing, reporting, and trading, to name just a few. And one thing all of these have in common is data. And it needs to be organized, stored, and managed correctly so you can leverage it across your business. Otherwise, you're just wasting a lot of time and money. Now, when we start working with an RIA or broker-dealer, one of the first things we do is a comprehensive data assessment. This provides a top-to-bottom view of all incoming data feeds and which downstream systems depend on them for successful processing and reporting. This data assessment is a critical part of any firm's growth plans, since it's the foundation of building or improving the firm's data warehouse solutions. Now, if you want to see your firm's data turned into an asset instead of staying a liability, you need to run, not walk, to our website, ezragroup.com, and click on the golden Contact Us button on the homepage. The experienced team at Ezra Group will conduct a detailed data assessment, deliver targeted recommendations to optimize your existing data warehouse systems, or put together a new cloud-based solution to help take your firm to the next level. You can schedule a free consultation by going to ezragroup.com. Now, a few quick housekeeping tasks. Please subscribe to this show wherever you listen to podcasts so you don't miss an episode. Please visit our sponsors, the Invest in Others Charitable Foundation, which you can find at investinothers.org. Now, let's kick this thing off. All right, here we are with my next guest on the program. I'm happy to introduce Iraklis Kourtidis, founder and CEO of Rowboat Advisors. Iraklis, welcome to the program.
Thank you. I'm quite flattered to be here.
I'm glad you can make it. Thanks for coming. So tell everyone, where are you calling in from?
The Boston area.
That's a great area. I'll be up there in September.
Okay. Hit me up so we can meet up.
Yeah. One of our sponsors is the Invest in Others Charitable Foundation.
Okay.
Their annual gala is at the Marriott down by the waterfront every year in September. So it's a great time to be in Boston.
Yeah, right. I remember because I was an undergrad in the Boston area and it was not fun.
Yeah, winters. It's late September, good time to be there. In the summer, it can get a little hot and sticky, but that's, the fall gets a little cool and pretty nice out there. Have you lived there all your life?
I'm sorry?
Have you lived in Boston all your life?
No, I'm from Greece. I came here when I was 18. Like I hadn't even traveled abroad. And one day I woke up and I'm like in Boston. So
you woke up here and here you were.
Yeah, no, it was a bizarre experience because I hadn't even traveled internationally and just came here and for undergrad and I ended up staying.
And what does the name, so Iraklis is a Greek first name. What does it mean in Greek?
It's Hercules, like the hero. Hercules is the Latin version of this. Iraklis is the Greek pronunciation of the ancient Greek is Heracles. For those audience members who actually care about these things.
Yeah, I do. I'm interested in etymology and where names come from. That's cool. All right, but speaking of where things come from, can you give us the 30-second elevator pitch for Rowboat Advisors?
Sure. We're a software company, only software, no GUIs, no database, no whatever, no full solutions, nothing you can click on. We only do two products. One of them is a portfolio optimizer, which we also call core investing engine, which basically you give it the client's current holdings and how you want them to trade, and the output is the orders that take you to the best portfolio, which in the general case is much, much more complicated than it sounds in like these 10 seconds. The other piece of software that we have is a tax simulator, which effectively uses the portfolio optimizer for simulating the behavior for a client. Like, for instance, you might say, okay, this client, I want the tax loss harvesting threshold of 2% and rebalance thresholds of this much. And then you look at it over a multi-year period of time and you say, well, it's not worth doing tax loss harvesting for this client. Or you might say, well, I should tune this little knob to the right and to the left to get the best results. So with a combination of these two pieces of software lets you tune a strategy for a particular client so you can like trade them automatically. Or if you want, you can always just put a human in front of the process that they can intermediate.
So with your software, you don't have, for example, an RIA platform that an advisor would use directly. You normally sell your software to other vendors to use as their sort of intel inside.
Exactly. Yeah. It's funny. I use that expression once, intel inside, with people who are younger, and they look at me like I have three heads. So I think this may only resonate to our crowds. But yeah, like our first deal, we're very fortunate to have a deal with what was then Iskowitz. And they essentially were exactly that. They took the software and they built an offering around it, but they were using the software at the core.
Yeah, it's great. I mean, there's so much out there. I mean, we at Ezra Group, we are experts in all advisor software, but when I started the company in 2005, the first project we worked on was designing a rebalancing engine. So rebalancing is very core to our hearts here, even though we've of course branched out into every other aspect of advisor software, but we still have a soft spot for rebalancing. But let's get a little more in detail into it. So your portfolio optimizer, well, first of all, who are you competing against? And why would firms select your portfolio optimizer over them?
That's a good question. I think like the closest thing to competing would be, there is essentially, to my knowledge, 4 companies creating portfolio optimization software. Now, there's several firms that have their own implementation. They don't license it out to people. So, we're narrowing our field into those. There's MSCI has something called the Barra Open Optimizer. That was the granddaddy, the original gangster of the, it started in like the, 80s, 90s. I don't know. I'm not the right person with it, but basically it's been around for a while. They were the original ones. There's another company which was called Axioma, and I think now they're called Contigo. And I remember when I was at Goldman Sachs in 2007, 2009, they were getting started, but I hear they had support from them. But basically it was kind of like, the way I understand it, MSCI Barra with the benefit of hindsight, kind of like redone. And then there's another firm called Northfield somewhere in Boston here. And then there's Robot Advisors. We have some things that are slightly different. Like, we're not as general products as they are. We specifically focus on the individual portfolios. And there are some nuances, and maybe this is beyond the scope of this particular podcast. But there's a few things that we do that are specific to managing individual portfolios. And, I don't mean like branding, like we go after those markets and we call those people. I mean, like, there's specific features that are that help that space.
So, Iraklis, just so you know, nothing technology related is beyond the scope of this podcast.
Oh, okay, right.
We're about deep diving into technology. So let's do that. So when you say a portfolio optimizer, that's different than a rebalancer, right? So
are you asking or stating? Because to me, I think of it as
I'm asking and stating. I'm stating it and then asking you to explain what's the difference between a portfolio optimizer and a rebalancer.
My understanding is that when people use rebalancer, they mean something that you can click on and get stuff done. And portfolio optimizer is the core. So we are the portfolio optimizer, the core, right? So
would it be that, for example, a portfolio rebalancer is more rules-based? If this, then that.
That's also my understanding. That basically the optimization, and I'm sure you know this, but since we're talking to a wide audience, there's a big difference between doing things with rules and optimization. Essentially, the problem that you're faced with with a portfolio is that you have multiple goals, which are often conflicting. If you only have one goal, it's easy. Like, if you're dealing with an after-tax, with a tax tax deferred account, then there's only one criteria, right? How do I get to my target?
Mm.
But if you have an individual portfolio, you usually have multiple things you care about. You care about tracking the target, obviously, but you also care about tax, ESG, and also transaction cost and holding costs. Like, you don't want all else being equal to hold a high expense ratio ETF. Just to take tracking and tax, that can often be a trade-off, right? It could be that you want to rebalance back to your target, but you will realize gains. So then you have to figure out, okay, what is that trade-off? And whenever you're dealing with trade-offs, the best approach known to man these days is using mathematical optimization. It's like a general set of techniques. If you have rules, the problem with rules is, I'll just give you an example from a previous employer, not to be named, which by the way, work perfectly in that context. If you have rules that say, okay, I will not rebalance a portfolio unless at least one asset class is more than 5% of its target. Okay, it sounds reasonable. But what do you do if you have like 3 asset classes that are 4.9% off the target? Do you do it? Well, not according to those rules. So you have to change your rules. And the problem with rules is that it creates a lot of what computer people like me call edge cases, right? What do you do right on the edge? And there's no clear way of handling trade-offs. That's the biggest problem, not even the edge cases. So the portfolio optimizer is kind of like a more general way of solving a problem. And the benefit of the portfolio optimization approach is that there's an old saying with computer science people that there's only 3 numbers in computer science: 0, 1, and many. You may have heard it if you're a computer science guy, right? So the benefit is like once you handle, 5 individual goals in the optimization, is relatively easy conceptually, not just easy to write the code for it, but it's easy conceptually to fit a 6th goal, right? Because now you have modeled things you have written code that can say, okay, give me like n different goals. So for instance, if you wanted to add expectations of returns, we might want to bump your portfolio, all else being equal again, you want to bump it towards stocks that you think will have a higher expectation of returns. There is a conceptually sound way of putting in the system. Whereas if you're dealing with something that's rules-based, it's kind of like, okay, since we're in older person analogies here, it's kind of like those old radio buttons. I don't mean like the UI control, like the actual radio, right? You push one thing and then something else pops out, right? You try to fix one goal and then some other goal gets messed up.
So with your tool, your portfolio optimizer, are you running through thousands of scenarios to try to find the ones that deliver the best results?
Well, this is okay. So the portfolio optimizer only runs the one scenario you give it. Now, of course, if you want to run 1,000, you just call it 1,000 times with 1,000 different settings for something, right? Now, what you're getting to though is important because sometimes this is more relevant when you're dealing like with a multi-year backtest / tax simulation. You might want to say, okay, I have this client where these are the things I know about them. Like this is the expectations that they have for future gains that they will have. These are the deposits they expect to make and so forth. Then you might say, okay, let me try all these permutations of settings. So you might say, okay, let me try 10 different tax loss harvesting thresholds and 20 rebalanced thresholds. So then what the backtester does is it fires off 10 times 20 equals 200 mini programs, threads, for those who know what they are, and then it assembles the results, and then it maintains this. You can think of this as a grid, right? Like it's a 2-dimensional grid here that's 10 by 20. So we maintain that structure, and then you get the results, and you can look at how different outputs of the backtest change. Like the most interesting thing is usually money-weighted returns, pre and after tax. But you can also look at things like trading amounts and so forth. Basically, you can dissect and analyze scenarios with the eventual goal of finding a sweet spot that might be appropriate for a client.
So you don't have to put each one in separately. You can say, try these 10 different the thresholds with taxes, try these 10 different thresholds of rebalancing, and then it'll just run through them all.
Yes, this is for the tax simulator, right? Like for the individual, one point at a time, single portfolio optimizer, then you have to tell it one thing at a time. Actually, that's even more complicated because we actually have the ability to run things in this, like these permutations, even with a single point in time. So that's something we built recently.
So another question. So are you generating the portfolio? Well, I have to input the portfolio. Is this like a mean variance optimizer? Or is
No,
this...
that's a very good question. So for those in the audience who may not know about this, the mean variance optimization is usually like you have 10 asset classes with a certain expectation of returns and standard deviations, the correlations between these two. Like for instance, Canadian stocks and US stocks are correlating that information. And then what it tells you is the optimal allocation, like you might say 23% Canadian stocks, 20% US stocks, and so forth. And this is something that we explicitly don't solve by design. What we take is the target is an input to the system, it's not an output. But the target allocation, somebody has decided, and this is usually a lower frequency task, right? Like somebody, like for instance, at Wealth from my previous company, the CFA investment research people, they would reevaluate these things every 2 years, but it's not like a daily decision, right? Like correlations don't change much. Where our software takes over is downstream of that. So you say, okay, given that you have to hold 23% or whatever of foreign stocks, and that these are the holdings that you have, and that you also have these constraints like ESG, wash sale avoidance, like all these things, what are the orders that can take you to the best, the portfolio that's closest to the one that matches the original target? And usually you can get exactly to the target. So how do you get in between? And just to point out something, if you could always get back to your target, I wouldn't need to be here talking to you, right? That's simple. The question is, what do you do if you can't get to the target? And that's where things get complicated. So that's where software takes over. It says, okay, I know I have to get to the target. I know these are the things that I have to get to, but I can't get to them. So how do I get as close as possible while heeding the relative preferences that we have for the different sub goals?
Indeed. So it does that, looking through these different models and looking through these different options to try to find the best solution given those input parameters.
Right. Like for instance, it could be that you might want to, if you sell something, it might get you closer to the target, but it's bad for taxes, but it may improve the ESG score. But of course, if you sell this, it means that you have to buy something else. And then it's infinite possibilities, basically. Now, of course, you might say, well, why do you try infinite possibilities? But because optimization basically handles this. So it's not like we have to enumerate them.
So I could put in parameters, for example, I want to increase alpha to this. I want to minimize risk and increase the diversity of the portfolio. I could give that as 3 parameters and it would come back with a solution.
Yes. And of course, whenever you have this, if you care about more than one thing, then you have to prioritize. I tell this to my wife every time she asks me to do 10 things. I said, I can't do all of them. You have to tell me what's higher important.
How does she respond to
that? She does not take to that lightly, but I just fall in line. You know how these things work. So when you give those things that you care about, you also have to say how much do you care for about each one, right? Because you can't get both. Now, of course, in some cases you're lucky, right? It could be that if you rebalance back to a perfect target, you also realize losses. And just to point out, it's a wide audience. In this portfolio optimization, realizing losses is always preferential because it's basically a form of kind of passive tax loss harvesting, kind of like what white magic is to black magic is realizing losses versus tax loss harvesting, which is like actively trying to seek it. So, so basically, you have to tell them how much you care about each of these goals. Sometimes you get lucky because going to the target would also realize losses, so it's great. But sometimes they're conflicting. That's where the problem happens.
Right, so when would losses conflict?
Well, I'll take the simplest, most extreme scenario, which is, let's just say, let's do the usual like 60-40 stocks to bonds portfolio. Let's just say like there's only 2 things you can hold. And somebody starts with 100% stocks. For simplicity, for the purposes of this discussion, let's just say all stocks are the same. So, you start with, somehow the example people give is like your grandmother, gave you as a bequest AT&T stock. I don't know why people do this. It's the same as 60-40. My grandmother certainly didn't do that. So you start with 100% of AT&T stock, and you might say, okay, on one extreme, I sell 40% of that and get 60% stock. But then I realize losses because, the stock was from 1970 or whatever.
You realize gains?
What's that?
You'd realize gains.
Right, exactly. So that's like one extreme. On the other extreme, you just don't touch the stock and you don't realize gains. And this assumes that all the holdings are at a gain, right? Just for simplicity. And then you have this other problem, right? Like now you're not tracking your target. In reality, what you could do, and you can imagine that the stocks are spread over different cost bases. So in that case, there's a trade-off because you might say that, you know what, if I'm at 100%, there's some sort of like low-hanging fruit tax laws that I can sell. And the ones that are maybe at a smaller gain. So maybe it's okay to get these. Oh, and also as I'm doing this, it really matters not to be at 100% stocks. But then as you get close to your target, you might say, you know what, I'm scraping the bottom of the barrel. I'm starting to sell the really gainy tax lots, which is bad because I'm realizing more taxes, which is bad. And at the same time, you know what? I'm close enough. I'm 65%. So maybe I should just stop there. So basically, you can think of this as like a gradual trade-off where it's like a little ball and like a valley, and like it kind of like settles in the middle, right? Like the optimizer essentially, in fact, almost visually, it actually does something like this. It finds the optimal point in the middle.
Is it the optimal point on a curve?
Yeah, it's not a curve. It's something, well, okay, I'm only going to say this because you said like this place is technical, but it's an n-dimensional polytope. And I have a feeling that A, your note-taking thing is not going to record this well, and B, this is the first and last time that sentence will be mentioned on the WealthTech Today podcast. So I'm proud of that.
We'll see. Maybe I'll start getting more into n-dimensional polytopes. I'll bring on an expert.
Yeah,
right.
I'm not an expert on these things. I know enough to do this because we use software that does these. But the idea is basically, because this sounds fancy to other people, it's like imagine having like a gem that's roughly cut, that's not really like the shape of a diamond, and you set it on top of a table. How do you find the highest point? You can look at every single point on the gem and say, okay, is this the highest? No. Is this the highest? No. Or what you can do, and the podcast cannot show my hand, but you just move your hand from the top to the bottom, and the second you touch like the gem, you're like, okay, that's the highest point, right? So essentially, that's what optimization does.
Mm-hmm. It comes out with it identifies that highest point from like a top-down approach.
Right. It does so, right. And it does so without looking at infinite possibilities. Because you might say, well, there's infinite points in that gem, but not really, because if you do this approach, well, there's only one thing at the top. And of course, it's more complicated how it does it. But it's kind of like the general idea that you have infinite possibilities, but you don't have to look at each one. Obviously, that would take infinite time.
Indeed. All right, so let's move on to the other product. So we just talked about the portfolio optimizer, and let's talk about the tax simulator. So how does that work? How is it different than other tax simulators on the market? What type of inputs does it take, and what kind of outputs are you getting from this?
That's a good question. To my knowledge, and again, I'm not in the business of trying to do market maps and whatever, I don't know, but for my discussions with way, way more important firms than us, I'm not going to mention names, but you can imagine. I don't think there's anything like this, like an actual productized thing that people can use. Like some firms have built something for themselves, but there's nothing like this out there. What we do is, there's never a good place in the podcast for me to mention this, but we have a very different approach because we've been working this for 8.5 years. We never have some investor or impatient person put the gun to our head. So we're able to do things in the long term. And because we're also a little OCD and focused on every little detail, what we did is something that I'm pretty sure nobody does, because we wrote a paper about it 2 years ago. And by paper, I mean peer-reviewed journal, not white paper that we put on LinkedIn. And it was my understanding that I don't think others are doing it. So the idea is the following. And by the way, I'm mentioning it may sound like I'm going down a rabbit hole, but I'm mentioning one particular feature that we have that I don't think I've seen elsewhere, even with people's internal non-productized versions, which is the following. Direct indexing with tax loss harvesting, or any form of tax loss harvesting, basically kind of assumes that you always have infinite gains to offset. And it could either be infinite long-term and no short-term, or an infinite of both kinds. And, it's, okay, you might say that traditionally this product was for the high-end market, and those people always had gains to offset, so what's the big deal, right? You can reasonably make that assumption. But as you're moving, this is a product that gets moved down market, then you might say, well, it doesn't make sense for everybody, right? Maybe one person has a finite set of gains to offset. And also this way you can model things like the $3,000 ordinary income deduction, which If you're a gazillionaire, it doesn't really, it's a drop in the bucket. If you're an individual, it makes sense. So one of the main inputs that you specify in our system is like what the expectation of future gains, so that when we do the tax calculations, the backtester, what it does is like it performs tax calculations on the January 1st, essentially, of every year. And if it ends up being like a tax payment, it withdraws the money on April 15th of the year, which is like the IRS tax date. So what we do is we take that into consideration, the external gains, and then if a loss that we realized cannot be used to offset the gain, it will become a loss carried forward, which is good. It's not bad. Like you always have the option of using it, but it's certainly better to offset an actual gain. And the reason why this is important is because this lets you smoothly evaluate the scenarios between one extreme where somebody has infinite gains to offset, and then like another extreme where somebody has no gains, and possibly even extra losses. In which case, you might say, well, you know what? Tax loss harvesting doesn't really make sense for that particular client. So I started with the most, you're asking the question, well, what are the things you can set? I just started with like the most unique. But there's things that you can do. You can say, okay, this client starts with $1 million on the first day. Then on the third Monday of every month, they deposit $10,000. Those $10,000 grow by 1% every year. You can even do deposits in stock to simulate executive stock grants. So, you can specify all these things, but instead of, essentially what you do is you give the system some sort of like rough rules to like go figure it out, but you don't tell it what to do every day. That's its job. And then with all these things, the portfolio gets updated from one day to the next.
Yeah. And
then at the end, you say, okay, this is the final portfolio. This is the cash in the account. These are the extra carryover losses that I have, which are valuable, and then you can compare.
So with these days, we're hearing a lot about AI and AI tools and large language models and generative AI. But you've been running this business since 2016. Is there any AI in the back end that's running some of these? Maybe this is the tax simulator using any AI to deliver its results?
No, there is not. I mean, I spoke with my computer science professor from Harvard. I met up with her recently. I told her about this, and I said, I need to figure out a way to graft AI into the system, because a lot of people get excited. She said, linear optimization, you can call it interpretable AI. I'm like, well, I guess she said so. But this is half in jest, but the real answer is no, because this is the type of AI, in my opinion, is good for things that have to do with patterns. Like large language models are basically that. There's patterns in sentences and you try to replicate those, right? This is something that is not quite an analytical solution like you solve an equation. There's pretty well-known rules on how to do this, right? Like, I don't think that this is a good fit for AI. Now, there is space for AI for a lot of things, including possibly coming up with the original target portfolio, which, as I said, is an input to the system. But, we don't do that. Frankly, I feel like even if we were to do this, by the time we did it, the fashion for this would go out of fashion. The same with that. You remember that time when you couldn't, everywhere you turned, everybody was talking about blockchain. You just couldn't, you heard everyone. Like, do you hear anybody talking about blockchain now? No. So, I mean, I don't want to trivialize this. AI is much more important, like much less BS than blockchain. But it's not really a good fit for what we do, in my opinion. Oops, you're on mute.
It's good to know what you do and what you don't do.
Yeah. I mean, we're very, very specialized in what we do because, we're a small company, so we have to focus on the things we know best. And, with AI stuff, okay, I have a computer science background. I could probably figure out a little better than the average person, but like, why do this, right? The problem is like, sorry, let me go on a little like old person rant here. I feel like part of the reason why you see a lot of trends is because a lot of the companies, their product is not necessarily their product, it's more them looking better to their next investor. So if you're like a small company, you're doing something with AI, okay, sure. By the way, I don't want to trivialize, maybe it actually makes sense. But also you want to use AI, all else being equal, because it's going to make you look better for your next Series A, because you're using AI, everybody wants AI, right? So because we never had that sort of like siren song, is that right?
The siren call.
Siren call, yeah, something like this. I should know this because I'm Greek, it's Odysseus. But like all I'm saying is like sometimes people, it's like the cart before the horse kind of situation for these things.
Well, Iraklis, time has flown by. Speaking of that, we're almost out of time. Is there any new features coming down the pike for robo advisors that clients can be expecting in the next 6 to 12 months?
We are actually like right as we're speaking, we're working on creating some tax rules for the German market. There's a German firm, we haven't announced them yet. I'll do that soon. But there's some specific things about them. Essentially, what we do is we keep. I noticed somewhere in your podcast you mentioned the concept of technical debt. We have what I like to call technical credit. Like it's so cleanly written that even if you mess things up, then it'll be normal. So because we have the patience to write things clear well, it's easy for us to like keep adding more and more features. And that's kind of what we like to do. So this thing that I mentioned with Germany is like an example of this. There's other things that we're doing, which is a very large bank has asked us for this, which is doing Monte Carlo simulations, which is similar to the backtest, except that we're generating market data on the fly. And then it's a little different because you want to average over like the 10,000 different pieces of market data. So like Monte Carlo is better, it's more regulator friendly, which is why we're doing it. So that's another thing that we're working on. But in general, we're just like focused on just like building more and more stuff because frankly, we kind of enjoy doing it.
And that's what matters, right? You got to enjoy your job. If you enjoy your job, it's not really work.
Yes, exactly.
All right, Iraklis, so where can our listeners find out more information about robo advisors?
Well, our website is www.robotadvisors.com. And the website itself is very old school. It was handwritten on Emacs, if you remember what that is.
I do.
Well, but we focus on content and substance instead of like presentation. At least that's why I like to say for not taking the time to make it look pretty. But we have a lot, like a lot of companies these days, they say about us and you click on them, they don't really tell you who they are. Like we actually put a ton of stuff on the site. There's no click here to talk to sales, mostly because we wanted people to have everything there. So there's actually a ton of information compared to what you normally find on company sites.
That's great. And I was staying at the URL a little too fast. It's Rowboat Advisors.
Yes, exactly.
ROWBOAT advisors.com.
Yes, thank you for having somebody with a non-Greek accent pronounce that correctly.
Yes. There you go. Well, Enrique, you said it all. Thanks for being here.
Thank you.
Hey, it's Craig again. Here are my top 3 takeaways from this episode. We really dug into some of the detailed functionality of Rowboat Advisor systems. First one was a portfolio optimizer, which differs from a rules-based rebalancer by using mathematical optimization to handle multiple conflicting goals. It takes target allocations as input, not output, unlike mean variance optimizers, which is a question I asked. And it finds the best feasible portfolio when perfect targets can't be reached. We also talked about their tax simulator, which has a unique ability to model finite gains to offset, unlike most direct indexing assumptions. It models tax calculations and withdrawals on specific dates and allows specification of deposit schedules, including stock deposits for executive grants. The development approach, they have 8.5 years of focused development without investor pressure, and they emphasize technical credit, meaning clean, well-written code that enables easy feature additions. Well, that's a wrap for this episode. You've reached the end of another episode of the WealthTech Today podcast. Thanks for listening. But before you go, please head to our website, ezragroup.com, scroll to the bottom of the homepage, and sign up for our newsletter. Once a month, you receive an email chock full of wealth management goodness, news, information, and updates. You will not be disappointed. Thanks again for listening, and talk to you all again next time.